When the numbers start telling a story, oil at $90, silver at $84, and a dollar that is quietly, steadily, losing the confidence of the world. If those three things are happening at the same time, you need to stop and pay attention. Because history has shown us, more than once, that when these signals align, something much larger is already in motion. And the people who noticed early were the ones who protected everything they had worked for. My name is Kevin Price, and today I am going to talk to you about what these numbers actually mean, why they matter to your financial future, and what a calm, intelligent person does when the system starts sending these kinds of signals. I want to begin with a story. Early in my journey of studying financial markets, I remember sitting with a thick stack of old newspapers, financial reports from the early 1970s, trying to understand how ordinary families experienced one of the most disruptive economic periods in modern history. What struck me was not the dramatic headlines. It was the quiet confusion of everyday people who had done nothing wrong. They had saved. They had worked hard. They had trusted the institutions around them. And yet they watched the cost of filling their gas tank double. They watched their grocery bills climb month after month. They watched the value of everything they had saved quietly shrink. And most of them did not understand why, until it was too late to prepare. That research changed something in me permanently, because the pattern I found in those old documents, rising oil prices, rising commodity prices, a weakening dollar, a government printing money to cover its obligations, that pattern did not stay in the 1970s. It has repeated. And right now, in the present moment, several of those same signals are flashing again. So let us start at the very beginning. Let us talk about what oil prices actually tell us about the health of the dollar and the global economy. Most people think of oil as just a fuel, something that powers cars and heats homes. But in the world of global finance, oil is one of the most important signals we have. Oil prices are denominated in dollars, meaning that when you buy oil anywhere in the world, you pay for it in US dollars. This arrangement, often called the petrodollar system, has been one of the primary pillars supporting global demand for the dollar for decades. Here is why that matters. When oil prices rise sharply, it often means one of two things, or sometimes both simultaneously. Either the actual demand for oil is increasing faster than supply can meet it, or the dollar itself is weakening, meaning it takes more dollars to buy the same barrel of oil. When both of those things are happening at the same time, the signal becomes significantly more serious. Because you are not just dealing with an energy supply problem. You are dealing with a currency confidence problem. At $90 per barrel, oil is sending a message. It is saying that the cost of energy, the foundation upon which every economy is built, is elevated. And elevated energy costs do not stay contained in the gas station. They flow through every single layer of the economy. The truck that delivers your food runs on fuel. The factory that makes your clothing runs on energy. The supply chain that brings goods from one country to another is powered by oil. When oil is expensive, everything becomes more expensive. And when everything becomes more expensive while your income stays relatively flat, you are experiencing the real-world consequences of what financial analysts call purchasing power erosion. Now bring silver into this picture. Silver at $84 is not just a number. Silver, like gold, has historically functioned as a financial barometer. When people lose confidence in paper currency, when they sense that the purchasing power of the money in their wallet is declining, they move toward assets that cannot be printed. Assets that have intrinsic, physical, tangible value. Silver is one of those assets. And when silver climbs to levels like $84, the market is collectively expressing something important. It is expressing doubt. Doubt about the stability of the currency system. Doubt about whether paper money will hold its value. Doubt about whether the institutions managing that money are making sound decisions. These are not random price movements. They are signals. And understanding what those signals are communicating is the difference between being prepared and being caught completely off guard. The dollar, meanwhile, has been experiencing something that does not make the front page of most mainstream news outlets, but is being watched very closely by serious investors and financial historians around the world. Its dominance as the global reserve currency is being quietly but consistently challenged. Nations that once held the majority of their reserves in dollars are diversifying. Trade agreements that once required dollar settlement are being restructured, and the trust that underpinned the entire petrodollar system for half a century is showing visible signs of strain. Is this a dollar collapse? Not today. Not in the dramatic overnight sense that fearful headlines often suggest. But is it the beginning of a long, slow, structural shift away from dollar dominance? The evidence is building in that direction. And the question is not whether you believe it or not. The question is whether you are positioned to protect yourself if that shift accelerates. Part 1 has given you the foundation. You understand what oil at $90 is really communicating. You understand what silver at $84 is signaling. And you understand the broader context of dollar weakness that ties these numbers together into a coherent and important story. In Part 2, we are going to go deeper into silver specifically. Why this metal, at this moment, deserves serious attention from any long-term investor who wants to preserve what they have built. Silver at $84, the most underestimated asset of our time. Most people, when they think about precious metals, think about gold first. Gold gets the headlines. Gold gets the television commercials. Gold gets the historical reverence. And gold absolutely deserves its place in any serious conversation about wealth preservation. But today I want to focus on silver, because silver at $84 is telling a story that most investors are not yet fully hearing. And the ones who hear it clearly and respond intelligently may look back on this moment as one of the most significant financial opportunities of their lifetime. Let me explain why silver is different from gold in ways that matter deeply right now. Gold is primarily a monetary metal. Its value comes almost entirely from its role as a store of wealth, a hedge against currency debasement, a form of savings that governments cannot inflate away. Gold's industrial use is relatively limited. Silver, by contrast, lives a double life. It is simultaneously a monetary metal with thousands of years of history as real money, and one of the most industrially essential materials on Earth. Silver is used in solar panels. Every solar panel manufactured anywhere in the world contains silver. As the global push toward renewable energy accelerates, the demand for silver in solar manufacturing alone is growing at a rate that is genuinely staggering. Silver is used in electric vehicles. It is used in semiconductors, in medical equipment, in water purification, in electronics of virtually every kind. The phone in your pocket contains silver. The computer you work on contains silver. The infrastructure of the modern digital economy is built in part on silver. This creates a demand dynamic that gold simply does not have. When the economy is growing, industrial demand for silver rises. When the economy weakens and people seek financial safety, monetary demand for silver rises. It is an asset that carries demand pressure from two completely different directions simultaneously. And right now, both of those pressures are building at the same time. Here is something that very few casual investors understand about silver. The ratio between gold prices and silver prices, known as the gold to silver ratio, has historically averaged somewhere around 15-1 or 16-1, meaning that historically, it took about 15 or 16 ounces of silver to buy 1 ounce of gold. Today, even with silver at elevated prices, that ratio remains historically wide. Gold is priced significantly higher relative to silver than historical norms would suggest. What that means, in practical terms, is that silver has historically been undervalued relative to gold for an extended period. And historically, when that ratio compresses back toward its long-term average, silver tends to move dramatically. Now I want to be careful here because I do not want to turn this into a price prediction. Nobody knows exactly when or how dramatically silver might move. What I can tell you is that the fundamental case for silver, the combination of monetary demand driven by currency weakness and industrial demand driven by the energy transition, is as strong as it has been in modern financial history. But here is the mistake I see people make constantly when they discover this case for silver. They get excited, they read the numbers, they hear the argument, and they go out and buy silver in the most expensive, least efficient way possible. They buy from retailers who mark up the physical product by 20 or 30% above the actual silver price. They buy at the moment of peak media attention when prices have already moved significantly. They put money they cannot afford to hold for years into an asset that can be volatile in the short term. And then, when silver pulls back, as it always does before its next move higher, they sell in frustration and conclude that silver does not work. Silver does work, but it requires patience. It requires buying with a long-term mindset. It requires understanding that you are not trading a commodity. You are preserving wealth over a multi-year horizon. The investors who bought silver with that mindset, who held through the inevitable dips and the frustrating periods of sideways movement, are the ones who ultimately saw the power of this metal in their portfolios. If you are considering silver as part of your financial strategy, the principles are straightforward. Buy physical silver or reputable silver-backed instruments from sources with transparent, competitive pricing. Do not put more into silver than you can afford to hold for 5 to 10 years without needing that capital. Think of it as financial insurance, not as a trading opportunity, and understand that the value of that insurance becomes most apparent exactly when you wish you did not need it. The lesson of part 2 is this: silver at $84 is not just a price. It is a signal from the market that the combination of monetary uncertainty and industrial transformation is creating genuine, fundamental demand for this metal. The intelligent response is not panic buying and it is not dismissal. It is calm, informed, strategic accumulation as part of a broader plan. Oil at $90, what energy prices? Tell us about the dollar's future. There is an old saying among seasoned financial observers: if you want to understand where a currency is going, watch what it takes to buy energy. Because energy is the one thing that every economy on Earth cannot function without. And the price of energy, denominated in dollars, is one of the most honest and unfiltered reflections of what that dollar is actually worth in the real world. Oil at $90 per barrel is a number that deserves serious contemplation, not panic, not dramatic reaction, but genuine, thoughtful consideration of what it means and where it points. Let me take you back to a framework that helps make sense of this. The petrodollar system, the arrangement by which global oil trade is settled in US dollars, was established in the early 1970s. Before that arrangement, the dollar had been backed by gold. Every dollar in circulation was theoretically redeemable for a fixed amount of gold held by the US government. When that gold backing was removed, the dollar needed a new source of global demand, and oil provided it. Because if every country in the world needs oil, and all oil must be purchased in dollars, then every country in the world must hold dollars. That demand is what gave the dollar its extraordinary post-1971 strength and durability. But that system is under pressure in ways that were unimaginable even 15 years ago. Major oil-producing nations are now accepting payment in currencies other than the dollar for a portion of their oil exports. The share of global trade settled in dollars, while still dominant, has been declining, and the countries that have been the largest holders of dollar reserves are quietly, steadily diversifying into other assets, into gold, into their own currencies, into alternative financial arrangements. When the global demand for dollars declines, the consequences are not abstract. They show up in prices, because if fewer people need dollars to conduct international business, the purchasing power of each dollar falls. And when the purchasing power of the dollar falls, oil prices expressed in dollars rise. Not necessarily because oil has become more scarce, but because the measuring stick, the dollar itself, has become less valuable. This is the deeper story behind oil at $90. It is not only about supply and demand for crude oil, though those factors are real and important. It is also about what $90 oil tells us about the declining purchasing power of the currency used to buy it. And the consequences of expensive oil cascade through the entire economic system in ways that affect every single person regardless of whether they own any investments at all. Higher oil prices mean higher transportation costs. Higher transportation costs mean higher prices for every good that moves through a supply chain, which is essentially everything. Higher energy costs mean higher manufacturing costs, higher utility bills, higher food prices. The inflation that ordinary families feel in their daily lives, that quiet, grinding sense that their money does not go as far as it used to, is deeply connected to the price of oil and the value of the dollar that buys it. Now here is where the investment lesson lives. When oil is expensive and the dollar is weakening, certain assets historically perform very well. We have already talked about silver. Gold belongs in that conversation. Certain commodity-linked investments and assets that are priced in or store value independently of dollar-denominated systems. These are not exotic or complicated ideas. They are logical responses to a clearly documented pattern. But the mistake that many people make at this point in the conversation is to overreact. They hear the analysis, they understand the logic, and they conclude that they should immediately restructure their entire financial life around the assumption that oil stays at $90 forever and the dollar collapses on a specific timeline. That kind of binary, all-or-nothing thinking has destroyed more wealth than almost any market event. The reality is that oil prices fluctuate. The dollar's decline, if it continues, will not be a straight line downward. There will be periods of dollar strength. There will be periods when commodity prices pull back significantly. The investor who builds a strategy around a single predicted outcome is gambling, not investing. The investor who builds a diversified strategy that performs reasonably well across multiple possible outcomes is the one who survives and ultimately thrives. The lesson of Part 3 is clear. Oil at $90 is not just an energy price. It is a financial signal about dollar purchasing power, about global monetary confidence, and about the real-world cost of currency weakness that touches every household regardless of their investment portfolio. Understanding that signal is the first step. Responding to it calmly and strategically, rather than dramatically and emotionally, is the second. The mistakes that turn financial signals into financial disasters. By now you understand the signals. Oil at $90, silver at $84, a dollar facing structural pressure from multiple directions simultaneously. You understand what these numbers mean individually and what they suggest collectively. And if you are like most thoughtful people who absorb this kind of information, you are feeling something right now, a combination of concern and urgency, a desire to do something, to act, to protect yourself and your family. And that feeling, that urgency, is exactly where the greatest financial mistakes are made. I want to spend this entire part talking about the errors that intelligent, well-meaning people make when they encounter real financial signals and allow their emotional response to override their rational judgment, because the signals we have been discussing are real. But the wrong response to real signals can be just as damaging as ignoring them entirely. The first and most common mistake is what I call catastrophic thinking leading to catastrophic action. This is when someone hears a compelling case about dollar weakness and commodity prices and concludes that a total financial collapse is imminent. They liquidate everything. They pull money out of every traditional investment. They convert their entire savings into physical gold or silver or crypto. They essentially bet their entire financial future on one specific outcome happening on a specific timeline. And markets almost never cooperate with that kind of certainty. The people who sold everything and moved into gold in 2012, convinced that dollar collapse was months away, watched gold fall significantly over the following years while traditional markets climbed. The signal they were responding to was not entirely wrong, but the timeline and the magnitude of their response were, and the financial damage they suffered was real and lasting. Diversification is not a concession to timidity. It is the acknowledgement that the future contains multiple possible outcomes and that intelligent investors position themselves to navigate all of them rather than betting everything on one. The second mistake is buying at the peak of fear. When oil prices spike and silver reaches record levels, financial media coverage intensifies. More people become aware of these assets. More people rush to buy. And that rush of buying, driven by fear and urgency rather than by prior research and strategy, typically happens right at the moment when prices are most elevated. The investors who benefit most from commodity price increases are almost never the ones who bought at the peak of media attention. They are the ones who built positions gradually, over time, before the headlines were screaming. If silver is already at $84 and you have never owned any silver before, the question is not how much should I buy right now today. The question is, how do I begin building a long-term position in a disciplined, staged way that does not expose me to the maximum possible short-term downside? The third mistake is neglecting the financial foundation in pursuit of the financial hedge. I have had conversations with people who were deeply concerned about dollar collapse and eager to build positions in precious metals and alternative assets, but who were simultaneously carrying significant high-interest debt and had no emergency savings whatsoever. That combination is genuinely dangerous, because if an emergency arises, and emergencies always arise eventually, they will be forced to liquidate their hedge positions at whatever price the market offers at that moment, which may be a very bad price. A financial hedge only protects you if you can afford to hold it, and you can only afford to hold it if your immediate financial foundation is solid beneath it. The fourth mistake is trusting urgency over analysis. The financial media and much of the content created around these topics is designed to create a sense of urgency. Act now. The window is closing. This is your last chance. Urgency sells. Urgency drives clicks and views and purchases. But genuine long-term financial strategy is almost never urgent. The right time to begin building a sound, diversified, inflation-resistant portfolio was yesterday. The second best time is today. But that process should be deliberate and informed, not frantic and reactive. The fifth mistake is abandoning a strategy the moment it does not perform on your expected timeline. This might be the most quietly devastating mistake of all. An investor builds a position in silver with a genuine long-term thesis. Silver then spends 18 months moving sideways or even declining slightly. The investor grows frustrated. They conclude that their thesis was wrong. They sell, and then, 6 months later, the very move they anticipated finally happens, without them, because they were not willing to hold through the period of discomfort that preceded the payoff. Long-term investing in any asset class, whether it is equities, real estate, precious metals, or digital assets, requires the ability to hold through periods that test your conviction. If you cannot psychologically tolerate watching an investment decline temporarily without selling, then you need to either reduce the size of that position to a level where the fluctuations do not disturb you, or you need to do more foundational work on your understanding of why you own it. Conviction built on genuine understanding is far more durable than conviction built on excitement. The lesson of Part 4 is this: the signals in the market right now are worth taking seriously. But taking them seriously means responding with intelligence, patience, and discipline. Not with panic, not with dramatic all-or-nothing moves, and not with borrowed conviction from the loudest voices in the room. Build your strategy on understanding. Execute it with patience, and protect it from your own emotional reactions. The final warning, and the strategy that stands the test of time. We have traveled a significant distance together in this conversation. We started with two numbers, oil at $90 and silver at $84. And we unpacked what those numbers are really communicating about the dollar, about the global monetary system, and about the financial environment that every one of us is navigating right now, whether we choose to pay attention to it or not. We talked about silver and why its unique combination of monetary and industrial demand makes it one of the most compelling assets to understand in this environment. We talked about oil and what elevated energy prices tell us about the real purchasing power of the dollar and the cascading effect that has on every household and every portfolio. We talked about the mistakes that turn good financial awareness into bad financial outcomes. And now I want to close with the most important message of everything we have discussed. Here is the final warning, and I need you to hear this clearly. The environment we are describing, rising commodity prices, a weakening dollar, growing global uncertainty about the monetary system, this environment creates enormous opportunity for predators, for people and organizations whose business model depends on your fear. They will tell you that you must act now or lose everything. They will sell you physical silver at markups so large that you would need silver to double just to break even. They will promote digital assets with promises of returns that defy all logic and all historical precedent. They will package fear as financial advice and charge you for the privilege of being frightened. The warning is this: In a genuine period of monetary uncertainty, the financial predator is often more dangerous to your wealth than the monetary uncertainty itself, because the monetary uncertainty is a slow, grinding, long-term process. The predator can damage you immediately, completely, and irreversibly. Protect yourself by slowing down, by researching before buying, by questioning urgency, by understanding that legitimate long-term financial strategy never requires you to make a major irreversible decision in the next 24 hours. Now let me give you the clear, actionable takeaway that you can carry with you from this conversation. The foundation comes first, always. Before any conversation about hedging against dollar weakness makes sense for your personal situation, you need a solid financial base. That means manageable debt, a genuine emergency fund, and a clear understanding of your monthly cash flow. Without that foundation, everything else is speculation built on instability. From that foundation, you build a long-term, diversified strategy that acknowledges the real risks in the current environment without betting everything on a single predicted outcome. That strategy likely includes some exposure to precious metals, both gold and silver, as a genuine long-term hedge. It likely includes a careful, limited, eyes-open position in digital assets if your risk tolerance genuinely supports it. And it includes the discipline to hold that strategy through the inevitable periods of doubt and discomfort that will test it. The numbers in this video's title, oil at $90, silver at $84, these are not the story. They are the opening sentence of a much longer story that is still being written. Nobody knows exactly how that story ends. Nobody knows the precise timeline. But the investors who study history, who understand monetary dynamics, who build diversified and disciplined strategies rooted in genuine understanding rather than emotional reaction, those investors have consistently navigated periods like this one with their wealth not only intact but strengthened. That can be you. Not because of a lucky prediction, not because of a dramatic move made in a moment of fear, but because you chose to understand before you acted, because you chose patience over panic, because you chose a framework over a feeling. The dollar may continue to weaken. Oil may stay elevated. Silver may climb significantly from here. Or the timeline may be longer and more complicated than anyone currently anticipates. What matters is not the prediction. What matters is the preparation. Kevin Price leaves you with this. If you like the video, please hit a like and subscribe button and hit the bell icon for more valuable videos.